China, I think, is in a tough spot, just like the US. You know, in a way, during the pandemic, what saved China when the property crisis really started to take hold was exports boomed. And we're now in an environment where the property crisis is still ongoing. Property sales are still very weak, negative, but exports are no longer a support. And so you've got this double whammy now, and it does really call for significant more policy support. And that support, I wouldn't say is significant at this point. It's coming, but coming in maybe too gradual, and that's, I think, what the markets are concerned about.
And you think that they really need to turn up the fiscal side of the stimulus?
Yeah, I think, you know, right now, when consumer confidence is so low, bank credit is not flowing that much. It's essentially like a liquidity trap, and so, you know, lowering the price of credit when there isn't that much demand isn't really helping that much. I think the bigger bang for your buck is using fiscal. They've started to use more fiscal. Perhaps they're keeping some of the powder dry because we're not sure, just like Jay Powell's not sure for the US. I think the policymakers in China are not sure how this is going to play out. So they're keeping some powder dry to see what happens. But our sense is there'll probably need to be more stimulus coming forward. And, you know, we've marked down our growth forecasts. We now think GDP growth in the coming quarters is going to be somewhere around 3.5%. And that will give you a full year growth number of around 4 or so.
Okay, well, but in terms of the messaging, right, from what we got from China yesterday, isn't it pretty meaningful that the China PBOC put, if you want to call it, the put is there? That's the messaging. And perhaps the market is going to hold on to those optimism and positive thinking. And that could in turn have some kind of positive wealth creation effect. Many are talking about they need to boost confidence, and maybe that could come from the stock markets, and maybe that was the messaging that we got yesterday.
Perhaps, but, you know, fundamentally for the stock markets to have a sustained rally, it's not going to come through official support for the stock market. Is going to come through more from stronger profits, stronger growth, and a more positive economic outlook. And I'd go back, Sherry, to what I was saying before. I think that really needs more fiscal support to boost, for instance, social welfare spending, a lot more support in terms of helping ensure that the pre-sold but uncompleted homes are actually finished and delivered, cleaning up the excess inventory in the property sector, getting property sales to be positive again, particularly in the smaller cities. These are all the things that are really going to help deal with the unemployment problems, the weak demand problems. I think stock market stabilization measures can work for a little while, but they're probably not going to lead to a sustained rally. I think it's more real water stimulus that's going to help promote domestic demand in China, reduce the excess, the capacity, reduce the deflation risk that is really needed. We're moving in that direction, but I think we're not there yet.
Yeah, I like that phrase, real water stimulus. Rob, you'd probably agree that for China, one of the top priorities is going to have to be supporting jobs and the job market, the labor market, right? Because there's more than anecdotal evidence. There are reports now that factories across the country are starting to close, shutter. Workers are starting to be furloughed as well. Yeah. So, you know, I think we should be watching out for stimulus specifically to support jobs in China. And to something you talked about earlier, this whole idea of excess Chinese capacity, right? And the vent for that, or the release valve for that being largely Southeast Asia. It might end up being Europe as well, I don't know. But, you know, if you're a consumer in Southeast Asia, that's great, right? Cheaper, whatever, that's made in China, right? But if you're a company in some of these countries in Southeast Asia, maybe not so great, because we've already seen, let's say, solar panels in Malaysia, all right? Chinese players came in, basically killed Malaysian players off. We saw something similar happen in textiles in Indonesia. Chinese players came in, Indonesian players got killed off, right? So these countries are also at some stage going to have to be worried about their own job markets, no?
I think it's not even at this stage. I think it's actually already happening, Martin. Okay. So we did a big study, and this is data up to the end of 2024, so before Trump 2.0 and the tariffs. And we found strong evidence that looking at all imports from China, all the various components of imports, and mapping it to manufacturing production. And we found a very strong correlation that the products where there was a lot of import penetration from China had weak production domestically. So the competition is already there. We were finding signs of deflation, producer price deflation, stronger in those sectors where penetration from China imports was there as well. And so it's already happening. And as you say, with the US tariff war going up, potentially other countries could raise tariffs on China as well. The US wants that. There's the risk of China redirecting more of its exports to Asia, and so Asia imports from China, and this flood of cheap China imports could get worse. And as you said, it can be good for consumers. It can lead to lower prices, lower inflation, but it can cause industries to really struggle and eventually close. And then you get the longer term effects as job losses, and then that hurts the consumer. So this is a theme, I think, that could actually intensify in the coming quarters.